I want to bring in billionaire value investor Mario Gabelli. He is the chairman and CEO of Gamco Investors. And Mario, we get to see you here every year. I know that you are a long-term guy. I know that you tend to look at companies, not necessarily company fundamentals and not necessarily the big picture. But there's some really weird stuff happening in the big picture right now. And I can't imagine it's not factoring its way into how you think about things.
Clearly, one has to think about how the banks could break an old philosophy. What Buffett does, Becky, what he did was he gets his float. I pay him for my insurance, and then he doesn't have to pay me for 3 or 4 years. He takes that, so he borrowed. The other guys take my deposits and lend very long. Rule 101, it's a challenge. And then they had an accounting.
So insurance is better than banking because
I agree with
you
that.
can't get your money back.
Right.
The deposits are much
You got your
stickier.
insurance, and it's been paid for, and you get the benefit of that down the road. So the second part of what Buffett does is patience. In other words, step back and look at the cycles, and he knows there are cycles. I mean, I started covering autos, farm equipment, conglomerates, and the media and entertainment. And during that period, the banks lost money on what they called oil tankers. And I said, why? Then in the 70s, they lost money with the banks, and then the real kahuna was in 1990 with the savings and loan. And they passed a rule called hold to maturity, and that's what the Fed should look at. How do we change that? How do we get that erosion in the value that's not translated onto the balance sheet and solve that problem? And then a couple of other things.
So just a simple accounting change,
Yes.
You think that would change behavior at the banks?
If
you had to market to market.
If you mark to market now, they would take a significant erosion on selected companies, particularly where they had office space and commercial real estate. You know, if I'm a politician, I would clearly be concerned about mortgages. I don't want to damage the mortgages that people hold. If I have a 3% 20-year mortgage, I'm going to be sensitive. But office buildings, they're not going to care. And that's where the challenge is right now.
So the banks we care about, not just because of bank stocks, that's a much smaller part of this, but the bank's health on the impact of the rest of the economy, what it means for businesses that need to borrow money, what it means for consumers who need to borrow money, credit crunch that comes, and all of these questions about commercial real estate.
From my end, what we look at is what is the cash flow of the company called EBITDA minus maintenance CapEx. Interest expenses below the line, and that's rising sharply. The companies that we follow and the earnings releases and what we're talking to, they're starting to manage, Becky, all of the working capital. You're starting to see the end of double ordering. You're starting to see inventories coming down. And that's very healthy on cash flow. The short-term challenge is, obviously, if you're borrowing on a rate called SOFR, LIBOR's gone, you're paying a lot of interest expense. For example, today, a company that sells fishing equipment reported earnings, Johnson Outdoors, J-O-U-T. And we just follow because we like the outdoor market, and we want to see what happened with the ebbs and flows of the cycle with regards to COVID. And interest expense was up sharply. But working capital is improving, and they're going to work on that.
Does that make it a stock you like or a stock you don't as the interest expense goes up?
No, the interest expense is an element in the capital structure, so that if I'm buying the company, what I'm looking at is what are they earning from the business, and how I refinance it is also a separate decision. Okay, like yesterday on First Horizon, I don't know what happened there. I just read some headlines as to why they walked away. On the other side, financial engineering, M&A, lots of that dynamic is at work. And so as a result of that, I'm going to see a lot more of the private equity organizations trying to figure out, the PE guys got a lot of money. They're going to try to figure out what deals to buy, and the prices are coming down.
Mario, you follow media very closely. You saw what happened yesterday with Paramount, where they slashed their dividend. Earnings were under a lot of pressure. I think the dividend getting slashed was a big surprise to a lot of people.
I disagree. I was in Barron's, and I said that they should cut it. And I was only concerned that Sherry Redstone had a company in the theater business that needed the cash flow. So she owns, let's say, 50 million shares at 40 cents, a dollar, to make it simple. So she was getting 40 million of cash flow with a very favorable tax rate. So now that they cut it, they're saving $2 billion, $1 billion over 2 years. They have to sell a couple of assets. The Federal Trade Commission stopped one sale, which is Simon & Schuster, and they'll get X dollars on that. And Bob Bakish is doing a very good job. So the stock dropping 6. I just sat there and just bought it. And Warner Brothers is probably down today in part because the negative implications of streaming and the cost of the content. If you look at the company, They've got 650 million shares. They'll call the stock 20. That's $13 billion with $12 billion of debt, $25 billion. Disney is